Good morning, everyone. My name is Alicia Barrett. I'm Training Officer for Taxpayer Services, and welcome to our webinar this morning. With me today, I have Jeff Foster. He's the Senior Tax Counsel for the department. And on behalf of Commissioner Garagano and the Department of Revenue staff, I just want to say thank you for showing up this morning to our presentation and the tax law changes passed in the most recent legislative session. We've had quite a few legislative changes this year, so the presentation will be covering most of our time here. We will be taking a few questions from chat. Just as a reminder, make sure that the little drop box, your chat is in the lower right-hand corner. Please make sure that the little drop box down there is changed to all panelists so that we can make sure that we get your question. For account-specific questions, we will be, there is a email address, revenue.support@tn.gov, and you can send your questions account related, or if we do not get to your question today, you can send those to that email address. So with all that being said, once again, thank you so much. And I'm going to go ahead and turn things over to Jeff, who is here with me today.
Great. Well, thank you, Alicia, and thank you everybody for tuning in this morning. As Alicia mentioned, we had a very busy session actually for Revenue Matters. It was nice to have things back up and running this year, honestly, after our shortened COVID session last year. We had a number of things this year. We had several sales and use tax law changes as per usual, given the importance of that law to our revenue, and a couple of F&E changes I'll tell you about. We had a number of interesting administrative updates dealing with collections and other matters. We had some dealing with registration, which will be interesting, I think. We had many alcohol-related changes, a lot of which deals with COVID, but not entirely, and a tobacco tax matter that we'll talk about a little bit. We're not going to discuss title and registration law. That's outside of the scope of this session. And also wanted to draw your attention to our website. We have really nice legislative summaries on the website at the address shown below, and that's really great. You can go on there and just and find those, and they're a great resource. If you want the entire text of the public chapter, you would have to go on to the Secretary of State's website. I'm getting chats that people are having trouble hearing. Is that the case?
Jeff, I can hear you fine on my end, and I don't know if maybe someone is having some audio problems themselves. So I think you should just please continue. Thank you very much.
Okay, great. I just didn't want to have my mute on backwards or something. Okay, great, wonderful. All right, well, having said that, let's jump right in with sales and use, because obviously that's the big one for our state. It accounts for about 60% of the revenue that we collect here at the department, and there were a number of interesting measures this session. The first one is Public Chapter 285, and that deals with the Streamlined Sales and Use Tax Agreement. Just a little bit of backstory on this one, and most of you probably know this who work in this area, but Streamline started about 20 years ago as an effort by the participating states to make the very disparate sales and use tax laws of those states uniform. And the purpose of this was to try to make it easier to administer for the taxing authorities and easier to comply with for the taxpayers. So the member states were required to adopt certain definitions and other provisions to stay in Streamline. And at first, for the first several years, first 6, 8 years, something like that, Tennessee was pretty aggressive about complying with all that. We adopted a number of definitions in 2008 that were required by Streamline and were sort of headed that way. But then as time went on, Tennessee, and not just us, but other sales tax dependent states began to resist the full implementation of the agreement. And for the past several years, the legislature has delayed the implementation of the Streamline provisions numerous times. They would kick it down the road a couple of years. We're not quite ready to do that. We want to study it more, and so forth. So Tennessee has kind of been in a bit of a limbo as far as Streamline. And this year, the legislature really went further and flat out deleted the provisions that had been delayed for these many years. So this doesn't absolutely kill Tennessee's membership in the agreement. And it doesn't really affect the administration of current law that much, because those provisions have not been effective. But it does really signal kind of maybe the end of Tennessee's moving forward on this, and so it's an interesting provision. I guess we'll see where we go with Streamline going forward. The legislature can always change its mind. It has in the past. All right. And again, as we said earlier, if anybody has any questions, just jump right in. We'll try to take them. We want to make this as participatory as possible. Another interesting, this isn't specific to sales tax, Public Chapter 214, but it does deal, it establishes some protections for taxpayers relying on published guidance from the department. So under prior law, before this, if a taxpayer relied on erroneous advice given by the department, by statute, that the taxpayer could only get a penalty waiver. And also, case law went further than that and provided that taxpayers could not be relieved of additional liability for tax or interest if they relied on erroneous advice for the department. And we would, in legal and the AG, we would refer to this as you can't assert estoppel against the state, and you can't, in particular, against the Department of Revenue. And the reasoning for that was like, well, it's so important to collect the revenue that is due under the law that trumps erroneous advice given by an auditor or whoever. It's just that important. So that was sort of the law, and this is, you can imagine people would not be super pleased about this from time to time when they would get incorrect advice, rely on it, and then come to find out that advice was incorrect, and they would be liable for additional tax or interest. So Public Chapter 214 changes this. And basically what it says is if a taxpayer is audited by the department or requests specific advice from the department and receives erroneous audit findings or advice, the taxpayer is not liable for any additional tax or interest under certain conditions. So the reliance has to be reasonable. The taxpayer cannot have misstated the facts. If it is, it can't misinform the department and then try to rely on this. So, but it really does change the playing field for all of that. The law clarifies that if the department or the commissioner changes its mind about the taxability of something, that can only be applied prospectively and not retroactively. That was probably in the law already, but this clarifies that. And it also, the bill requires the department to establish audit procedures about making written findings in the audits. And I'm getting a question, must the advice be in writing? And the answer is no. If the advice can be oral, if it is documented, if the department's records can be if it can be shown that it was requested and the advice was given. So it's not absolutely necessary for it to be written. It's probably better for it to be written because just for record keeping purposes and evidentiary purposes. But this is a significant change in administration and practice, and we think it's very taxpayer friendly and will lead to good things. So turning to our next matter here, we have Public Chapter 480, which establishes a new procedure to allow customers to request certain sales and use tax refunds directly from the department. Now, under prior law, only the dealer or the seller could request a refund. The customer who had actually paid the tax and that was collected by the dealer was not generally allowed to. The dealer had to request the refund, and it also had to prove to the department that it had refunded its customer to avoid the double dipping and all that. That it had refunded it or provided a credit memo or something to get the refund. Now, this has caused problems from time to time in that from time to time, customers would think, well, I don't really think that transaction was taxable. I don't think that the dealer should have collected from me. But the customer's largely powerless to do much about it if the dealer wasn't interested in doing it. So this changes that and it establishes, like I said, a procedure to allow the direct request. The particulars the customer's claim for refund must exceed $2,500 per dealer, and the customer must have unsuccessfully requested a refund from the dealer at least twice. So you have a dealer who's just not interested in doing this. The law also requires that the customer must submit a dealer attestation form whereby the dealer states that it collected and remitted the tax and is not seeking a refund. It must state the amount of the tax and a schedule of the local jurisdictions impacted. So we know what's going on with the local tax and what should go where. And you might be thinking, well, isn't that going to be hard? Couldn't that be hard to get that attestation form if the dealer has already refused to, follow up on the customer's request? And the answer to that is there is a provision in the law that states that if the customer is unable to secure the attestation, the refund may still be granted if the commissioner is satisfied that the above information required in the attestation form submitted is valid, is correct. So even if the customer can't get the dealer to do it, it can still obtain the refund if it can obtain the information. So again, we think this is going to be a positive thing going forward and will untie the hands of some of these consumers who tried to get refunds, unsuccessfully get refunds in the past. So Moving on to our next matter. This is another sales tax matter, and it deals with the filing. Public Chapter 275 deals with the frequency of filing. So again, under prior law, sales and use tax had to be filed monthly as a general matter. The only exception was when a dealer averaged $200 less per month in sales, in which case the Rule 74 allowed quarterly or annually filing. But other than that, there was really no provision for taxpayers to file any on a less frequent period. So this changes that, and it allows dealers with sales and use tax liability over a 12-month period that averages $1,000 or less per month to file either monthly or quarterly. So again, that is trying to ease the administrative burdens on smaller taxpayers who, you know, that's a significant burden for a taxpayer who only averages that amount. It allows the law also includes provision allowing the threshold to be adjusted every 5 years for inflation beginning January 1st, 2026. And again, this is again trying to give the smaller taxpayers a break and sort of lessen the compliance burden on them. We're getting a number of questions in here. I think maybe the thing to do is to just kind of go through and catch them at the end as much as we can to kind of keep the flow going. And happy to do that. If we run out of time, I can or we can of course answer at a later date, and happy to do that. I love all the questions, by the way. Okay, moving on to some more sales tax matters. Public Chapter 86 deals with mains, pipes, pipelines, or tanks that are attached to a structure or installed underground for a system that conducts steam, gas, oil, or water. Or really any substance that's required to be moved in these networks. And what it does, it excludes those things from the definition of tangible personal property, which means that they're not taxable for sales tax purposes. And the reason this came along is that we have gotten into disagreements with taxpayers on several occasions about these. And the department thought that these were actually TPP, tangible personal property, and thus taxable under the law of fixtures, which is part of property law. It's a very complicated area of the law. There's a lot of factors that go into it, and so it's hard to achieve predictability by just applying the law of fixtures. But the department prevailed in a number of these cases, and so this law was passed to clarify that these are not tangible personal property. So similarly, like the mains, the pipes, pipelines, and all that, railroads, tracks, structures, and other sort of ancillary improvements to railroads are also excluded from the definition of tangible personal property, and thus not subject to sales tax. So that is a major change, and will end hopefully a lot of litigation on this matter. Another exemption that came along this session is Public Chapter 139, and that exempts online access to continuing education courses that meet certain regulatory requirements. if the courses are offered by charitable organizations, specifically 501c3 or 501c6. So I think there was some question as to whether these were exempt before, and this clarifies that. All right, our next matter here, Public Chapter 477, it deals with the aviation fuel tax. And so the aviation fuel tax is a species of sales tax. And under the prior law, aviation fuel was subject to a sales and use tax of 4.5%. And also, the law provided for a cap of $10.5 million in tax per year for any one person's sale, use, or consumption of aviation fuel. So Public Chapter 477 changes this. It does it in a couple of ways. It lowers the rate from 4.5 to 4.25%, and it also lowers the cap for any person operating an aircraft or licensed air carrier in a transportation hub from 10 million to 8.5 million this fiscal year. And next year, starting next fiscal year, it's going to lower the cap to 5 million. Now, transportation hub has a very specific definition. I won't read it to you as it's sort of long, but it serves to really limit the reach of this law. And it does not include the Nashville airport. So we think that this law will only pertain to one taxpayer. But so it's not an across the board kind of thing, but is very significant with the change in the aviation fuel tax. So I said we had a lot of sales and use things, and we do, and we have a couple of new sales tax holidays that were created this session. One creates Public Chapter 456, creates a sales tax holiday on food ingredients, and prepared food, and that runs the July 30th, 2021 through August 5th, 2021. And Public Chapter 592 creates an entirely different sales tax holiday on gun safes and gun safety devices. And that runs to July 1st, 2021, all the way through the end of the fiscal year, June 30th, 2022. So that's the end of our sales and use tax provisions. As I said, we always have a number of them, and there was some interesting ones. And like I said, we will try, if we have some time at the end, to swing back around and take some of these questions. I really appreciate all the questions coming in through the chat. All right, moving on to the next, maybe most important tax that we administer is the franchise and excise tax. As I'm sure all of you know, the franchise tax is a species of property tax. It's on net worth or the value of the property owned or used in Tennessee. The excise tax is a type of income tax. And the way it is calculated, we start with federal taxable income and then have statutory additions and subtractions that are specific to Tennessee. So we had a couple of changes this session with regard to F&E. The first one is Public Chapter 154. Now this creates an excise tax deduction for payments that are received from Tennessee COVID relief programs that are funded by the Federal CARES Act or appropriations under Title VI of the Social Security Act, if the funds were received within certain dates, March 1st, 2020, the beginning of COVID, through the end of this year. Again, the reason you would think, why would this ever be taxable in the first place? Well, it's because of how our taxing structure works. If this ends up in federal taxable income, which it would for taxpayers, absent a federal deduction for it, then it is included in the excise tax base unless it is specifically excluded. And it wasn't before, so that made it taxable. And so the legislature didn't like that, rightly so, I think, and changed it by taking it out of the tax base. Another really significant change for F&E, this will be of particular interest to practitioners and very welcome, I would think, for them, is Public Chapter 559. And this basically establishes a 7-month franchise and excise tax extension. Under prior law, the extension was 6 months. And so if you made the estimated payments that you were supposed to under the statute, you've got an automatic extension for 6 months. So if you're a calendar year taxpayer, you've got until October 15th. This extends that for an additional month. So all the practitioners I know would really will like this. Gives additional time to compile books and records and get the return done. So that I would think that would be greatly cheered in the practitioner community. Again, wow, that's just great questions. This is wonderful. Again, like I said, I think the best way to try to handle this is to plow on through and see what kind of time we have toward the end and see what we can do with them at that point. We will certainly get back to you, later if we can't today. So that's all we have for F&E. So let's just keep on trucking forward here. The next one we have deals with tax collection and the statute of limitations. Public Chapter 217 deals specifically with the collections limitation period for taxpayers in bankruptcy. And I think this is, from a legal perspective, a very interesting issue. So let me set the stage a bit. First, Section 67-1-1429 is the collection statute of limitation, and it provides that a tax assessment must be collected within 6 years after the assessment becomes final. So, yeah, and there are really not any exceptions to that. It is what it is. If the department is too late, it goes away. There's no way to collect it. At the same time, if a taxpayer files for federal bankruptcy protection, an automatic stay kicks in, which prevents any creditor, including the Department of Revenue, from taking any collection action until the bankruptcy court lifts the stay. So if a taxpayer had an assessment and declared or filed for bankruptcy protection, us in legal and everybody in the Attorney General, as far as I know, including the bankruptcy division over there, had always thought and assumed that the taxpayers filing a bankruptcy petition would operate to stop our collection statute of limitation from running. We just thought, how could it be otherwise when we are prohibited by law from taking any collection activity? Well, lo and behold, somebody challenged that and pointed to some language in the statutes and got the court to agree. And the court said there's nothing in the law that states this or requires this, and so the 67-1-1429 continues to run, even though department, you are precluded by law from taking any collection action. So obviously that is not a good result for the department and the state. So the legislature came in, changed the law, Public Chapter 217 stops the statute of limitations from running upon imposition of the bankruptcy stay or the filing of any other proceeding in which the department is prohibited from collecting. I guess that could be a receivership or something like that. The statute of limitations resumes running 30 days after the stay is lifted. So from our perspective, from the department's perspective and the AG's, this is a very good law, which allows us, everything to be held in abeyance until the bankruptcy is concluded or the court lifts the stay. All right, I'm going to continue on here. The next matter we have deals with film and TV production tax incentives. So again, this one has quite somewhat of a backstory. Under prior law, an F&E credit was available for certain film and TV production activities that occurred in Tennessee. Now, this law was very broadly written, and it was so broadly written that it made it difficult to administer. A lot of activities that were arguably not intended fell within the literal letter of the law, and so we were getting some results that were not great, and were not really in line with the purpose of the statute, the intent of the statute. So, in light of that, a few years ago, the legislature just repealed the whole business. Said, enough, this is out of control. But in the meantime, our neighboring states, Georgia comes to mind as an example, were very successful in attracting films to their state because they had aggressive incentives in those states. And it was thought that really contributed to the local economies. So the legislature sort of decided to get back into this field. And so it passed Public Chapter 70. Now this is very different from the previous law. This is much more narrowly tailored and specific, and hopefully will be much easier to administer. It does a couple of things. It creates a new sales and use tax exemption for tangible personal property, computer software, and services used in the production. And at the same time, it creates a franchise and excise tax credit, but only applied to payroll expenses paid in Tennessee for qualified positions. The qualified productions, it has a definition there, it's pretty broad, it includes films, TV episodes, video game production, post-production, editing, and esports. And again, we're hopeful that this will provide the incentive that Tennessee needs to get this activity here, which I think everybody wants here, but without creating this just totally open-ended tax thing, which is really hard to administer and sort of keep up with. So hopefully this will work better. All right. The next matter that we'll look at deals with it's a registration and reporting law dealing with micro markets. So you might be thinking, what's a micro market? Micro market, think of the little store or shop or whatever in your office building that you walk in. You can get snacks, drinks, things like that. It doesn't have a cashier or human in there checking you out. It's done through a machine. You put your credit card or whatnot in. So the problem with these things, there was a lot of confusion as to how to register them and report them for both business tax purposes and sales tax purposes. So Public Chapter 289 tries to clean some of that up and clarify it. So first of all, on the business tax side, the law says businesses should should obtain one business tax registration for each jurisdiction where the multiple micro markets are operated, rather than trying to register each individual location. So that, you know, in the past, it's been location based, and everyone had that in their mind. So there was all this, you know, uncertainty about how to do it. So hopefully that'll clear that up for business tax purposes. On the sales tax side, dealers who own or operate multiple micro markets in Tennessee should file one sales tax return and report sales from each local jurisdiction on a consolidated basis. So again, this is just trying to give some guidance about these things, because there's been a lot of you know, uncertainty kind of swirling around about how to handle them. All right. Next, we're going to talk about some just some kind of miscellaneous tax matters. There's stuff that doesn't quite fit anywhere easily, so we just kind of lumped them and called them miscellaneous. And so the first one is Public Chapter 113, and that exempts all contributions or distributions made to an individualized education account for, or, you know, on behalf of participating students from all state and local taxation. So just decided to go in and dispel any uncertainty on that and say that none of it is subject to any kind of tax. There's a little caveat there: purchase of taxable school supplies or other items that would normally be subject to sales and use tax, if you use funds from the IEA, are going to remain taxable. But the contributions and the distributions are tax-free. The other miscellaneous matter on this slide, Public Chapter 264. And this deals with the short-term rental marketplace. So just a little bit of background on this. Historically, the hotel occupancy tax was a local tax that was remitted by the operator of the establishment to the local jurisdictions. And that was the end of the matter. The Department of Revenue didn't have much of anything to do with it. Few years ago, with the rise of Airbnb and VRBO and all these kind of marketplaces, the law was changed to provide that short-term rental marketplaces were to not report and remit in that way, but they were to remit the local occupancy tax to the Department of Revenue. So when this happened, it caused some uncertainty about vacation lodging service. And a vacation lodging service is defined in the statute as a person or entity that is engaged in the business of providing the services of management, marketing, booking, and rental of these short-term rental units. And the law clarifies that these folks are not a short-term rental unit marketplace, and these services, these folks should remit the local occupancy tax to the locals, to the local jurisdictions, and not to the department. So it's an attempt to clarify a part of the law that has caused some confusion in the past few years. So hopefully it will do that. All right, let's go on, and next want to talk about the Central Business Improvement District fee. Now, under the prior law, the national metro government imposes a fee of 0.25% on retailers on the sales price of certain items, certain tangible personal property and services sold within a specific district in downtown Nashville. And it includes Lower Broad, goes over to the Cumberland River, out to 8th Avenue, and Charlotte. So it's basically that kind of square down there. And the fee, the law provides that this fee must be used to assist in recruiting conventions and providing security and stuff like things like that are naturally associated with the downtown area. The fee is reported on the retailer's sales and use tax return on a separate schedule. Now, it was 0.025%. And now the legislature has increased this to 0.5%. So the tourists and other folks enjoying the downtown area will pay a little more for that privilege. So that is the end of our miscellaneous and collection, sales and use, and F&E. And so now we're going to turn to alcohol measures. As I mentioned earlier, there's several of them this year. A lot of them are related to COVID, but not entirely. So we'll try to run through. There's several of them, so I'll try to move fairly quickly and get through. The first is Public Chapter 451. And this deals with LBD tax and drive-through and all this stuff. So just a little bit of background here. Before COVID, before March 2020, we had liquor by the drink, the license, and the tax. The license was issued to restaurants and hotels or other qualifying establishments, allowing them to sell alcohol containing 8% or more on the premises. The tax was 15% on that. When COVID hit, the governor issued Executive Order 17, which allowed basically single servings of alcohol and sealed wine bottles to be sold by restaurants and taken away. But there was no LBD on these sales, as the law prohibits the governor from enacting tax measures by executive order. So that was sort of the state of things. And then Public Chapter 451 came in to clarify that, okay, we're still going to allow the licensees to make sales of alcoholic beverage via the drive-through, the pickup, or carry out until July 1st, 2023, so a couple years. But we're going to clarify that LBD is owed on these sales. So that sort of cleans that up going forward and provides a couple of year window to continue a practice that folks have gotten used to and the restaurants have gotten used to. So that's sort of that one. Public Chapter 185, that it basically just caps the delivery service charge at 10% on the price of the alcohol being delivered. And it also clarifies that the licensed delivery service is not responsible for remitting the taxes otherwise due on the alcohol it delivers. That's going to still be the responsibility of the retail package store. So anyway, it's just, I guess it's just trying to provide some guidance, some cap on the price of that service. Continuing on with all our alcohol stuff, Public Chapter 324. This really deals with Tennessee's brand registration system. So under the prior law, basically, for those of you who work in this, Tennessee is a 3-tier system. The manufacturer must sell to the wholesaler or the distributor, who then must sell to the retailer. So under the prior law, different wholesalers might have distribution rights to the same brand, the same type of brand of alcohol, but in different areas of the state. So this led to some confusions when brands were registered with different wholesalers. It was unclear who had the rights to distribute what where. So this law is an attempt to correct that, to provide transparency as to who has the distribution rights in what particular county. And as you can see there, it requires the department to provide some information in the alcoholic beverage brand registration database. And it's just trying to make that procedure and that kind of structure more transparent so we know who is selling where, who has the authority. All right. Okay, another alcohol-related measure was Public Chapter 331, and this deals with direct wine shippers. So a few years ago, the law was changed to allow an in-state or out-of-state winery to ship wine directly to consumers in Tennessee. And the original intent of this was really, imagine someone visiting a winery in California or Oregon or wherever, or here, and wanting to buy the product, but not wanting to carry it home on a plane or something like that. So the idea was, well, we should allow these individual wineries to ship their own product directly to the consumer. So the law was passed. But what really happened, how it turned out, is these third parties got involved and started sort of selling all sorts of stuff under the guise of this law. They were, called themselves fulfillment centers and all this stuff. And the administration of it kind of got wonky and a bit out of control and all this. So the legislature came in this year and says, look, we're direct wine shippers can only ship their own stuff. And by that, we mean wine sold under a brand name, owned or licensed to the winery, stuff produced by the winery, produced exclusively for the winery under an existing contract, or produced and bottled exclusively for the winery. So we don't want people selling other people's product all over the place, because it's hard to keep up with. It's hard to manage. So it does allow for fulfillment centers, and it creates a new license for them and regulates them. It also clarifies that the direct wine shipper must pay the tax, the alcohol beverage gallonage tax, and the sales tax, regardless of whether it uses a fulfillment center to fill the order. So it's not, the wine shipper can't say, oh, we had a deal with a fulfillment center to pay. They were supposed to pay this tax or something. That doesn't fly. So anyway, this is just an attempt to sort of regulate this, to streamline it, and to make it easier to administer. Okay, we have another item that deals with direct wine shippers, and that's Public Chapter 425. And it basically says that it authorizes direct wine shippers that manufacture less than 270,000 liters of wine per year to ship up to 54 liters of wine to an individual per year. And this, again, just puts some parameters on this, trying to make it easier to administer and to deal with, because this area sort of has gotten out of control a little bit. So trying to make it more manageable. The other one on this slide, Public Chapter 437, this deals with this allows alcohol manufacturers to basically use samples at a retail location by either picking them up from the wholesaler or having the wholesaler deliver to them. And it also requires the wholesaler to issue a zero invoice. Because if the wholesaler doesn't do that, then it's assumed that the sample is going to be subject to tax when the manufacturer uses it as a sample. And this is trying to state that the manufacturer also is entitled to sample its product, to conduct tastings in this, and it should be able to do so without being subject to tax. So again, this has been a problem that under prior law it was thought that wasn't the case. We have a beer matter this year, Public Chapter 432. And this really deals with small breweries. So think your craft breweries, those who brew up to 25,000 barrels per year. And, you know, I described our distribution system basically goes from manufacturer must sell to a wholesaler to must sell to a retailer. There was a little bit of an exception for this for the small breweries in county. They were allowed to self-distribute their own stuff. But this extends that, and it says if a craft brewery located in one county wants to self-distribute in other counties, it can do so up to a maximum of 1,800 barrels per year. But if the manufacturer distributes in other counties more than 1,800, it must enter into a contract with a wholesaler, which is that's the general law. So this is just trying to give the small breweries the option to sort of run their own show, self-distribute to a certain extent. And if it gets too large, they have to follow the rules like the normal law with regard to beer distributorship. So that is all we have for alcohol. Again, it was a busy year, some of it COVID, some of it just other issues that have come up. So we have one more substantive thing to talk about here, and that's the tobacco tax. It's Public Chapter 69. And what this does, it exempts smokeless nicotine products from the Tennessee tobacco tax. And it provides a definition of smokeless nicotine products. That's something in the form of solid, gel, gum, or paste, that it's intended for human consumption. And it does not include tobacco or tobacco products such as snuff or chewing tobacco. And the issue here is, to be taxable, these substances had to contain tobacco or tobacco substitute. So there was some confusion. Well, you know, if it has nicotine in it, that's part and parcel of a tobacco product. Does that make it standing alone subject to the tobacco tax? And the legislature came in and said, no, it does not. It actually has to have tobacco or tobacco equivalent or substitute in it. So that is all I have as far as the substantive stuff that happened. It looks like we're pretty close to the end of the hour, so I will guys, what do you think? Do we have some time for questions, or how should we handle this?
I think maybe take one or two questions. Anyone that is waiting for answers, so to speak, I just want to go ahead and encourage you. I'm going to go ahead and put the information slide up here on the screen. And so this has got the email address, the contact number. We will try and pull a couple of questions from chat just to answer, and then we will go ahead, and anyone else who does not get their question answered, feel free to submit a question to revenue.support@tn.gov. One of the questions that we got was, if someone films videos for country music, what qualifies it as a film?
Well, let's see. We have a definition of, we have our definition. Qualified productions includes films. I sort of think that the definition will be broad enough to include that, but I'd want to spend some time, with the definition itself and sort of looking at the legislative history and all of that. But it seems as if we're filming a country music video or something that's, produced at a professional level, and all that it would qualify. I think it would, but again, this is a brand new statute and would need to really, dig in carefully to make sure.
Absolutely. And the last question that I'm going to go ahead and take today is related to the tax advice from the department. And it's asking about, would the reliance include tax advice in an email from the department using the website form submission? So I'm assuming that is referring to the revenue help feature.
Again, I think so, because the statute says if a taxpayer specifically requests advice and is given advice, then the protections kick in. It doesn't have to be limited to an audit, and it's more broadly written than that. So I do think that would count, that would qualify.
Okay. All right.
Alicia, just real quick, one other question that came up I thought was really interesting on micro markets. On the registration part of this, if you're a micro market, we need only one location registered for sales tax and business tax. If you're currently already registered, what we'd like you to do is to send us an email so that we could work with you as a taxpayer to determine which location will be continuing and which ones will be ceasing, and we can work that out for you. If you are going to be registering micro markets from now until October, probably just send us an email about that as well. We'll route it to our registration experts and see what they want to do. There's a possibility that they might want you to just register one location per jurisdiction now, but I would rather them, as the experts, be able to tell you that directly. So if you will use revenue.support@tn.gov, we will route that to the experts, and we'll be happy to get back with you on that.
Okay. All that being said, just want to go ahead and wrap things up today. As I said before, this is the email. If we did not get to your question today, please feel free to reach out using the revenue.support@tn.gov. There's been a lot of people that have asked about the slideshow and about seeing the slides, the presentation, and just wanted to make sure that everyone knows that it's going to be posted on our website underneath taxpayer education and tax webinars. It will be in the webinar library probably within the next couple of days or so. We have been recording this event. So all that being said, I hope that you all have a good rest of the day, and thank you so much for attending today.
Thank you, everyone. Thank you,
Thank-
Jeff, as well. Thank you.
What?
Bye-bye.
Absolutely. Everybody have a great day. Thank you.